Welcome back to the Deep Dive. Today, we're jumping right inside the AZZ Inc. fiscal Q3 2026 earnings call. It just hit the wires on Thursday, January 8th.
Yeah.
And we got a lot of numbers to get through, but I think the real story here is the incredible pace of strategic change that's happening inside this company.
That's exactly it. Our mission today is pretty simple. Cut through all the noise of the financial beats and really get to the core narrative.
Right.
Because AZZ presented a quarter of, high divergence. You had one stellar segment carrying all the weight while the other one kind of struggled. But the real headline,
There's the balance sheet.
the massive financial cleanup they executed. And that is precisely why the stock closed up, over 6.5% on the news. They didn't just deliver execution, they delivered a strategic plan.
Okay, so let's unpack that high-level picture first.
Yeah.
Management is out there framing this as a record quarter, and the numbers seem to back that up. They beat on the top and bottom line.
They did. On the profitability side, adjusted diluted EPS came in at $1.52. That beat the street's expectation of $1.48, so a nice 4-cent beat.
Right.
Revenue was $425.7 million. That sailed past the consensus of $418.2 million. And that's, a 5.5% jump year over year. Pretty solid.
And here's where I think the quality really shows through. Adjusted EBITDA hit $91.2 million, which gives you a really robust adjusted EBITDA margin of 21.4%.
Yeah, that's strong.
So given that, the market reaction makes sense. The stock surged $7.21, or 6.56%. But to really understand why the market got so excited, we have to look deeper.
You absolutely do, because this was a tale of two very different segments.
Okay.
The metal coatings business was, without a doubt, the growth engine. I mean, sales here were just explosive. They jumped a massive 15.7% year over year to $195.0 million.
Wow, okay, 15.7%. That's huge. And management pointed to some big secular tailwinds. What were the key drivers there?
This is pure infrastructure and industrial growth. You've got the U.S. infrastructure investment cycle, industrial reshoring, and critically, energy transition projects. So think solar, specialized T&D work.
Hang on, before you continue, for listeners who might not be in the weeds on this sector, what exactly does T&D work mean here?
Oh, right. Good question. It stands for transmission and distribution. So basically, it's all the big metal structures, the poles, the equipment you need to move electricity from, say, a solar farm to your house.
Got it.
It requires these super durable coatings like galvanizing, which is AZZ's bread and butter. It's a huge multi-year demand cycle that's happening right now.
Okay, so with that kind of incredible demand, why did management say that metal coatings margins, which were still fantastic at 30.3%, were marginally impacted? Shouldn't pricing power be through the roof?
That's a great critical question, and it does seem a little counterintuitive. Management explained this was actually a conscious strategic choice. They decided to chase volume in some of these larger, more price-competitive projects, especially in electrical and solar. It was a calculated trade-off. They accepted a tiny bit of margin pressure now to lock up massive volume in these huge long-term infrastructure contracts.
So they're playing the long game,
Yeah.
market share dominance.
Exactly. It's a capacity utilization play.
Okay, that makes sense. Now let's pivot. The other side of the business. Precoat Metals. How did that segment do?
Well, Precoat was definitely the challenged segment this quarter. Sales slipped a little bit, down 1.8% year over year to $230.7 million.
And why was that?
They're just still dealing with softness in some of those cyclical end markets, non-residential construction, HVAC, transportation.
So we have this growth story in coatings, but more of a stability story in pre-painted metals. Tell us a bit more about the Precoat business model, because they're still pulling in $230 million in revenue in these soft markets.
And that gets to the core of Precoat. They operate mostly on what's called a tolling model. This means they're processing customer-owned metal. They're not taking on the big commodity price risk themselves.
So that structure acts as a defense mechanism.
It's a huge defense mechanism against deep volume swings or pricing volatility. It's a very stable, cash-generating business, even when volumes are a little flat.
That underlying stability is important context. So were there any bright spots inside Precoat to offset that weakness from construction?
Oh, a huge one. And I think it's underappreciated. Food and beverage container demand hit new record highs.
Really?
Yeah, this is being driven by that powerful secular shift away from plastics and towards aluminum. You see it everywhere. And Precoat is perfectly timed for this. Management also highlighted that the ramp up of their new facility in Washington, Missouri is really helping there.
What about on the competitive side? I'm thinking specifically about imports.
Yeah, management sees a major tailwind coming from import replacement. Pre-painted metal imports right now are about 10% of the U.S. market, and those imports are down significantly. We're talking around 35% this year. So as that excess imported stuff gets absorbed, AZZ expects to pick up that domestic demand.
In that Washington, Missouri facility you mentioned, how quickly can we expect that to really hit the bottom line?
It's ramping up strongly. They're expecting to hit a 75% exit rate in Q4, so that should help margins. But the capacity is still mostly focused on their current partner for now. We probably won't see decisions on allocating the rest of that new capacity until the first half of fiscal 27.
Okay. The operational story is fascinating, but none of this happens in a vacuum. We have to talk about how management paved the way for this quarter with their strategic financial cleanup. The balance sheet execution was, it was arguably the biggest headline here.
It was crucial, and the market saw just how big of a commitment it was. They ran an incredibly aggressive deleveraging campaign. Long-term debt fell to $535 million.
And just to put that in perspective for everyone,
that's down over $300 million from $852.4 million at the end of fiscal 25.
Dropping debt by over $300 million in just 9 months, while you're still funding CapEx, paying a dividend, and buying back stock. It's just extraordinary discipline. What enabled that speed?
Just massive, massive cash flow generation. Operating cash flow over the first 9 months just soared to $452.9 million. Compare that to just $185.6 million the prior year.
Wow.
That cash flow was the ammunition for the debt paydown, and it paid off quickly. Their net leverage ratio is now 1.6 times, which puts them right in their target range of 1.5 to 2.5 times. Hitting that target gives them so much more strategic agility.
So with that new financial flexibility, where's management putting the capital now?
They're maintaining that discipline. They paid the quarterly dividend of $0.20 a share. That's 63 consecutive quarters now?
Long streak.
It is. They did say they'll evaluate it annually going forward. And they were also active buying back stock, $20 million worth in the quarter at an average price of about $99 a share.
And the M&A pipeline, are they ready to start spending?
Yes. They confirmed the pipeline is very active. But they're focused on small, accretive, bolt-on acquisitions. Management actually called them onesie-twosies.
Huh, I like that.
Yeah, so, small, easily integrated businesses that fit their playbook, especially in metal coatings. They are not looking for some big, risky, transformative deal. They want value-add tuck-ins.
Okay, let's connect all of this to the macro picture. The U.S. industrial landscape seems incredibly supportive for that metal coatings business.
Yeah.
Beyond just general infrastructure, what are the biggest secular tailwinds you're seeing?
Well, you're seeing this confluence of 3 huge investment cycles all at once. First, you have the infrastructure bill, which is a steady, long-term driver.
Right.
Second, the energy transition is accelerating. That means coatings for solar projects, all those T&D upgrades we talked about. But the third, and maybe the most powerful right now, is this intense wave of investment driven by generative AI.
And how exactly does generative AI create demand for specialized coatings?
It's all about hyperscale data centers. And these aren't just, big warehouses. These are massive construction projects. They need specialized protective coatings for everything, not just the structural steel. They need it for power generation equipment, grid upgrades, cooling systems.
The entire ecosystem.
The entire ecosystem. It creates these multi-year, high-margin revenue streams. It's a very positive long-term trend.
And beyond data centers, you also mentioned another interesting growth area, metal roofing.
This is a really significant trend, especially on the residential side. Metal roofing is currently about 14% of the replacement market and only 5% of new construction, but its share is growing fast.
And why is that?
A few things. Building codes are changing, storm damage resistance is becoming critical, and, even homeowners associations are loosening up their standards, especially across the South. Think Florida, Texas, Arizona, Southern California. It's a huge addressable market for them.
Okay, but despite all those strong trends, management did still mention some lag in the non-residential construction market.
Yeah, non-res is still a bit subdued. It's largely the lingering effects of higher interest rates, general uncertainty. Management noted that the lag effect is still at play here. General capital projects usually have a 6 to 9 month lag time between when credit conditions ease and when you actually see that demand turn into orders.
All right, before we get to our final segment, let's just nail down the updated outlook. They narrowed their full-year guidance for fiscal 2026.
They did. And narrowing guidance this late in the year is usually a sign of confidence. They updated sales to between $1.625 billion and $1.7 billion. Adjusted EBITDA is now seen between $360 and $380 million, and adjusted EPS is narrowed to $5 and $26.20.
And they've really set themselves up for what should be a very favorable comparison heading into Q4.
Oh, it should be a huge sigh of relief for them. Last year's Q4 was an operational nightmare. They had unusually wet and cold weather, gas curtailments. They reported 200 lost production days. So unless there's another deep freeze, Q4 this year should look significantly better just from normalization.
This sounds like the perfect time for our This Is Not Financial Advice segment. Given the strong beat, the deleveraging, the exposure to these huge secular trends, what's the outrageous but plausible trade idea for AZZ?
Well, if you connect all the dots, AZZ has been operating as a top-tier industrial compounder. I mean, they have crushed the sector up over 17% last quarter versus the industrial ETF, XLI, at just over 3%. And all of that outperformance is being driven by metal coatings.
Right, by the infrastructure and data center exposure. So if they're already outperforming, where's the value gap?
The market is still valuing AZZ as a unified industrial conglomerate. It's trading at a blended multiple. But that metal coating segment, it's a 30% plus margin, double-digit growth business tied to multi-year non-cyclical cycles. A pure play asset like that shouldn't trade at the same multiple as a stable, cyclical precoater.
Which brings us to your pitch.
Given the exceptional growth of metal coatings and the fact that they've cleaned up their balance sheet so fast, the next logical step is for a strategic peer to recognize this value gap and bid for the metal coating segment alone.
A strategic breakup. That's an aggressive call.
It is. The trade is long, AZA, expecting a strategic breakup premium. A sale of the high-growth metal coating segment would generate a premium high enough to justify the recent surge and probably go significantly higher. And critically, that would leave the remaining Precoat Metals business, that stable tolling model with the aluminum can upside, as a highly underrated, pure cash-generating machine.
The parts are worth more than the whole.
The parts are worth significantly more than the whole in this current structure.
That is certainly a thought-provoking idea to chew on. So to recap our deep dive, AZZ delivered a very strong Q3 driven by the exceptional performance in metal coatings and a massive rapid deleveraging campaign. This gives them extreme flexibility heading into a final quarter with favorable comps and bullish guidance.
The narrative is clear. The market rewards companies that get their house in order while proving they're plugged into these multi-year trends that are shaping the economy.
So what does this all mean for you? The final thought to mull over is this. Management is aggressively pointing to secular growth in data centers and the aluminum shift. Given how fast they cleaned up this balance sheet, are they signaling a much bigger move than just those onesie-twosies M&A deals? Are they positioning the company to maximize value through a strategic sale? Or is this just the beginning of a multi-year compounding story, something to track as we head into the next fiscal year?